What's up, guys? I'm Jeff Montgomery and welcome to Tax Planning on the Whiteboard. If you like what you hear, make sure you hit that subscribe button. Today we are going to examine how much in potential lifetime federal income taxes could be saved by correctly completing a Roth IRA conversion over time, not all at once. To do this analysis correctly, we need to make some basic assumptions about the case and then compare the before and after results. Now, quick disclaimer here, guys. This is not specific information to anyone watching this video. This video will show how your account could potentially perform under these situations. These examples are hypothetical only and not intended to predict future market conditions or your personal experience. Not intended to provide tax, legal, or investment advice. Be sure you can consult a qualified professional in the areas about your individual needs. All right, now that we got that out of the way, let's go to the whiteboard. Okay, let's dive into the analysis and start with some basic assumptions about this case. So we're going to have a hypothetical couple here, and we'll call them Bob and Carol. Both are 60 years old, and they both have a life expectancy up to age 90. They have a combined $1 million in retirement savings, and to make it really simple, let's assume Carol has a $500,000 401k, and she did a direct transfer to a traditional IRA, and then Bob did the same. So the money's now in a traditional IRA. The new traditional IRAs are invested exactly the same way, and they're earning an annual pre-tax average of 6.4%. Let's assume that they have account expenses of around 1.5%. Required minimum distributions for Bob and Carol begin at age 75 for this couple. And the RMDs are not needed, so they're going to reinvest the required minimum distributions. Believe it or not, we run into this scenario all the time. Clients will say, Jeff, I don't need my RMDs. What should I do with them? I basically tell them there are really three things you can do with your minimum distributions, and those are you can spend them. We highly encourage folks to spend their RMDs. They worked hard for that money all their life. You can reinvest them, or you can give them away. So those are the three things you can do, and in this case, Bob and Carol are going to reinvest them. Now, here are the tax rate assumptions over the next 10 years for this couple. Remember, they're not going to convert the entire $1 million at once. I'm assuming a pretty high federal tax rate for these folks, 35% during conversion years. Also, this is strictly federal income tax liability. This does not include state income tax liability, IRMA adjustments at age 65 for Medicare situations, or the potential Social Security tax torpedo that we've discussed in many past episodes. If you are not familiar with any of those terms, that's even more of a reason to contact a professional to help you with Roth conversions. There are a lot of tax gotchas out there. Okay, so that's our assumptions. Years 1 through 10, they're converting and paying a federal rate of 35% on the conversion. In years 11 and beyond, they're going to fall into a 24% tax bracket. And at death, the beneficiaries that inherit the remaining IRA funds will also fall in a 24% tax bracket. So those are our tax assumptions. Let's go take a look at the whiteboard and see how this plays out in a before and after scenario. Okay, switching over to the whiteboard. What we're going to look at on the left-hand column, we are going to have our traditional IRA listed on the left-hand side. All right. And remember, this was a $1 million combined traditional IRA, one for Bob and one for Carol. So combined funds, $1 million. Now, if they keep it in an IRA and their life expectancy, remember, is up to age 90, the total taxes paid on required minimum distributions, which begin at age 75, is going to be $446,880 on the required minimum distributions. Now remember, we said Bob and Carol, they're being forced to take out required minimum distributions, but they don't need the money. So they are going to reinvest it. So remember, we said they could spend it, they could reinvest it, they could give it away. They're going to reinvest it. So the taxes paid on the reinvested RMDs is an additional $168,000. Okay? Now, life expectancy is to age 90. Under the Secure Act, a non-spouse beneficiary, typically a child, would inherit the IRA in this situation, and they have 10 years to withdraw that account in full. And they're going to pay taxes at their tax rate at the time. Many times, children are in their high earning years, so it could be even higher than the estimated 24% that I'm using in this example. But taxes paid on the remaining value of the IRAs at age 90 that would be paid by the beneficiaries is an additional $428,000. So we have a grand total of over $1 million in taxes paid by this couple, Bob and Carol, on their $1 million worth of IRAs at the time, taking out RMDs all the way until age 90, reinvesting those RMDs, and then the remaining amount being passed on to the beneficiaries. Okay, now what if they go ahead and they do a Roth conversion, right? So they're going to convert to the Roth, just as our example said, over a 10-year time span, and they are going to convert at a rate of 35%. And in this example, it's kind of an extreme example, they're going to convert the whole million. Oftentimes, you're not doing the entire account balance over that time frame. You might want to do half, 3/4, whatever you're comfortable with. But the taxes paid on that conversion, $350,000. How about taxes paid on the account growth of the Roth? Remember, we're assuming a 6.4% account growth in both columns here. Well, guess what? A Roth grows tax-free for a qualified distribution, making sure that you adhere to the 5-year rule in the Roth. So the earnings in the Roth will be tax-free for a qualified Roth distribution. So no taxes on the growth of the Roth, okay? There's no reason to reinvest anything because there are no required minimum distributions on a Roth IRA either. So now, life expectancy age 90, the beneficiaries inherit the Roth IRA. Guess what? No taxes on the Roth IRA that's being inherited. The 10-year rule still applies, right? However, the beneficiaries could leave the money in the Roth IRA that was inherited. We call that a beneficiary Roth IRA. They could leave that in there for 10 years and take that out in the 9th year on the 364th day prior to the 10 years, and that would have another 10 years of tax-free growth. Fantastic estate planning strategy as well. Total lifetime taxes, $350,000. Now this is a hard pill to swallow because you are voluntarily paying the taxes up front at a 35% rate in this example. So that's very difficult to swallow. However, you're buying the IRS out of your life for $350,000 compared to over $1 million in a traditional IRA lifetime total taxes. So which side of the ledger would you prefer? Okay, Make sure you check out the tables listed in the show notes. It shows how these calculations are made and what they are based on. Very, very important information. Check out the show notes. If you would like an analysis done on your specific retirement situation and understand tax planning, go to the link in the show notes, fill out the quick form, and you can see what kind of lifetime potential taxes are in your traditional IRA. As always, if you like these videos, make sure you hit subscribe, and we'll see you next time on Tax Planning on the Whiteboard.